Morgan was just talking about entering into contracts, putting 20% down, and you're dealing with somebody that's on the other side of the world. We're dealing with different currencies, and how does that actual mechanism, how does that exchange take place?
And let me also add to that, as Morgan talked about, from the standpoint of, there was an underlying theme from the standpoint of his sourcing product from overseas. And though I will give the answer along with the question, what would be the main number one concern of someone who is sourcing from overseas, whether it's China or anywhere within the world, will be the product basically that you saw initially is going to be of the same quality and quantity and et cetera specifications when it comes time for them after they've moved their manufacturer and they ship the product to you. You clearly, of course, as an importer sourcing from overseas, want to ensure that you're receiving what you ordered before you make the payment. That's a key, before you make the payment. If we reverse this around and look at it from the perspective of if you were an exporter, what is it that you as an exporter want? You know that you're manufacturing and producing the best product in the world and you're number one, et cetera, et cetera. But the one main thing that you want after that receivable is on your books is getting paid. And you clearly would love to get paid prior to shipping the merchandise. But in this day and age, there are many multitude of factors that prevent the exporter from getting paid first before they ship the merchandise, and the importer receiving the merchandise first before they make the payment. So it's a struggle, it's a tug of war, it's an issue. And then you couple that with the political and the economic and the social conditions of the world and the currency exchange and the fact that this is what's happening today and that's what's going to be happening tomorrow. It is a tug of war, and it's something that you need to balance as you move forward. All right, we have 4 methods of payment, and these are the 4 methods of payment that are been around for longer than I've been around. And whether you're buying or selling, this is a concern of both the buyer and seller as to which one to use, and you have to approach a happy medium, as I mentioned earlier, in this tug of war of assurance that you've received the product that you ordered and you as the exporter getting paid before you ship the product. Cash in advance, as indicated on the screen first, is clearly, put it to the next slide, clearly advantageous from from a exporter's perspective, because clearly the money is in your checking account before the product's leaving your doorstep. But as mentioned, sometimes it might be necessary for you to come up with some type of flexibility in your terms, anywhere from 30 to 180 days before you get paid. And that's great, you're given financing in this transaction. Or you might require a 30-30-10, for example, a 30% advance payment, 30% somewhere halfway in between the manufacturing of the product, 30% payment before you actually load it on board the vessel, and then extra 10% hangs out there when the buyer receives the product. He sees everything is fine and he remits you to you the last payment. Generally speaking, if that buyer didn't pay that last 10%, 9 times out of 10 the seller has already received the cost, et cetera, and maybe a little bit of a profit. That extra 10% usually is the full profit in the transaction. If you reverse this around, you can see where if you're sourcing from overseas and they're requiring cash in advance, that's cool. You might have an issue regarding how that payment will be sent overseas, when it's to be received, etc. The next slide, when she gets going, talks about an irrevocable documentary letter of credit. The rankings that I have listed these are from a exporter's perspective. So if you want to look at it from an importer's perspective, you just reverse the list. So if someone is selling a product and they can't give cash in advance, the second benefit for the exporter is to receive an irrevocable documentary letter of credit, which by definition provides that guarantee of payment to the seller, provided certain terms and conditions have been met in the transaction. And I'll let you go through about 2 slides. Again, this is the one that says letters of credit. Yeah, there's bullet points there as to when to use each of these transactions, and I'll leave that for your leisure reading after this presentation. Sometimes, though, there's an inability to get cash in advance, and there's the inability for the overseas buyer to issue a letter of credit in your favor, so we've got to come up with some type of flexibility in the transaction. And there are 2 more that are there, and the next one is a documentary collection, whereby, okay, go back please. What I did in the book is since this was a China presentation, I found a Chinese letter of credit, and go back one more slide. This was a letter of credit that was issued in the SWIFT format, which is the common format for all letters of credit to be issued. And this document, properly executed and properly submitted to the bank that's affecting the payment, is going to allow you to receive the proceeds. If you stop and think about it, if you are doing a shipment overseas, there are going to be shipping documents involved in this transaction. A letter of credit is just a detailed piece of paper that says this commercial invoice must say this bill of lading must say that, and if you do everything that the document says and present it to an appropriate bank, you receive payment. So you have cash in advance that allows I better get myself with where the slides are. My eyesight is just not that good to see the screen that we're looking for. One more slide. The documentary letter of credit and a cash in advance transaction, of course, provides the most benefit to the seller. But there's a cost factor involved. Not only a cost of a letter of credit for issuing from the buyer's perspective, but a cost factor for the exporter, and that might be something that the buyer just doesn't want to do. And if you are sourcing the product, you have to undergo the same scenario if the person that you are sourcing the product from overseas is requiring you to give them a guarantee of payment. You're going to have to go into your local bank and establish a letter of credit at some cost. The letter of credit goes overseas, and the seller, in order for them to get paid, have to conform to the terms and conditions in that letter of credit. I want to mention that when you as an importer are issuing a letter of credit in favor of somebody overseas, you're putting documentation requirements in that letter of credit enabling you to clear the merchandise through U.S. Customs. That's clearly a plus. Well, on the reverse, if you're an exporter and receiving a letter of credit overseas, you have to understand that the buyer is going to be placing in the letter of credit not only the documentation requirements that they need to clear the merchandise, but there also might be some governmental additional documents required that will be placed within that letter of credit that you have to comply with. And why I mention that is when U.S. banks issue letters of credit on behalf of importers here, we try to make them as simple and easy as possible. Yet on the reverse, if you are the exporter receiving letters of credit, I've seen some that have 4 simple document requirements to some that have 21 document requirements, 4 pages long. It all depends upon the certain circumstances, your merchandise, the dollar value, and the country that the transaction is going to and from. So cash in advance gives the exporter benefit of receiving payment prior to shipping the merchandise. A letter of credit gives the exporter a guarantee provided they do something. But if there is what is this, documentary collections? If there is keep going, DCL. Go back one. If there is a reasonable understanding or relationship between the buyer and the seller, and the transaction is that the merchandise is going to be manufactured and is going to be shipped, and there is a trust from the seller's perspective that the buyer will pay. There is another method of payment whereby the same set of shipping documents, rather than going to a bank under a letter of credit, go to a bank on a quote-unquote collection basis, whereby there's trust in the event that, or to the effect that the bank that's acting as the collector for the seller will contact the seller, will contact the buyer and say, here are the documents that you need to pick up the merchandise, please pay. It's only an attempt to collect the proceeds. There has to be good relationship between the buyer and the seller, but it also is important enough that this transaction, because it is going through banking channels, if the buyer suddenly says, well, I just want to pay this, the buyer will have, in essence, a black mark in the back of the mind of the bank in the foreign country of not paying an obligation from the United States. So, you know, there's a plus there, but there's still no absolute guarantee of payment that you would get under a letter of credit, or of course clearly that you would get if you received cash in advance. The last method of payment commonly used is an open account, what we call an open account relationship. And that's when there is total trust between the buyer and the seller. There's an agreement that, based upon the terms that were laid out in the initial contractual obligation or purchase order or agreement, that payment will be made as agreed. Shipping documents go directly to the buyer. The buyer picks up the merchandise, clearly will examine the merchandise, and if there's a net 20 or a net 30 days for payment, then payment is sent out. People commonly say that they really don't need an international banking department to perform international transactions. Well, in every one of these transactions that I've outlined, yes, a bank with international services provides the expertise that's needed, but even in the simplest transaction, for example, the open account transaction, a bank is still there and required to physically do that overseas wire transfer. So in any purchase or in any sale in the United States, there is a bank in the United States that is involved in this trade transaction. I don't know what my time was because I can't see the clock behind me, but let's go to when it says remembering financing considerations. Extending credit terms to first-time buyers. For example, if you are sourcing from China and ask for them, paying for it in advance or paying for it when the merchandise arrives. If you can get 30, 60, 90 days out of the transaction before you physically have to pay the seller overseas, I mean, that clearly is going to be advantageous from you from the standpoint of at least the product will be on your shelf. You could turn it around and possibly receive full proceeds or full retail value for the product before you have to pay the source from overseas. So there's an advantage there. But clearly, extending long credit terms and long does increase your risk of default. And this is very common from the standpoint of export sales, where you go up to 180 days, and it's great, but what happens if the buyer during that 180-day window of time files bankruptcy and just goes out of business? You are, in essence, stuck with that receivable not being paid, with the exception, if we wanted to take this course to another level, of you receiving some type of credit insurance for that foreign receivable. And that's probably for topic number 2, 3, or 4 down the road. So there are other ways in which you can insure receiving payment if you are an exporter. If you are an importer, the initial comments made by my colleague here to my left regarding the fact of how they look into and determine that the company they are sourcing from will manufacture the product that they are looking for and that they want, not only today but in the future, is very important.